Hi, welcome everybody to the webinar that is for the 5 years of the UAE VAT law organized by us, ITC. So it's a good morning to one and all present. We would like to start the webinar, and apologies for the delay that has happened. We're waiting for other participants to join in. So as we continue with the 5 years of UAE VAT law, next slide, please. So we would first like to highlight about us, about ITC. So we all know, we have been conducting many webinars now. So this would be a short introduction about us, about our growth in this 5 years. So ITC was founded in 2019 by our founder, Mr. Emma Sharafuddin, who was then associated with FTA as an auditor. And also, he is the reason that the ITC was founded, because he believed in helping out the people and the tax recipients outside the FTA, and also to give them more help in the VAT law and the tax regime purposes. So as we see in the slide that in 2019, the ITC was established. In 2020, we had a growing team. In 2021, we were expanded in the Oman section. In 2022, we had some elite clientele base that we were founded. And in this year, it was very much a landmark year, since we had many, one of the biggest achievements, which we'll be talking ahead in our slides, one of the biggest litigation that we won. And also, it was a steep in the career, because many of our elite client base joined our firm and joined the ITC family. And in 2023, again, it was a landmark, because we expanded our business in Abu Dhabi, and we have opened an establishment there. So going forward, next slide, please. So going forward, we shall be speaking about how the VAT was actually implemented, how it was found in UAE, why exactly there was this need. So basically talking, we know that the UAE countries, GCC countries, were firstly mainly based or dependent on the oil and gas industry, considering that being the primary source of income then. So in 2008, actually, the initial discussions began of implementing this indirect tax regime. Why? Because in 2008, there was a financial crisis that all over the world that went the shockwaves, and everybody was compelled to think about a second source of income for the same. So considering this, this was thought, it was given a thought that why not have an indirect tax regime which could regularize economic regulations here in the GCC countries as well. Going forward, after a lot of discussions and thinking about and so on and so forth, it was decided that in the year 2016, the agreement to be signed. And that's when the GCC member also signed the GCC VAT agreement, where it was decided that the VAT law would be implemented and the excise also would be coming in forth. So in 2017, the VAT law was issued by VAT executive regulation in November 2017. And in 2018, the VAT law was implemented on 1st of January 2018, having the 5% as a taxable supplies and the zero rated, the exempt, all this coming in source. So what actually were the benefits of having this kind of an indirect tax regime? We all know that everywhere in the world except UAE and GCC countries, this VAT was there. So the way of calculation or the base of the law is the same. But what exactly was here in UAE that was a little different than the others? Firstly, they wanted a wider scope of tax, a tax that could be a regime that be comprehensive and also, it should be covers everything, and it should be beneficial to each and every businesses out who are been doing in UAE. Ease of tax administration with the adopt of technology. Obviously, going with the digitalization of age, it was required that the tax law that is implemented it should be so it should be aligned with the technology, and to also be it will be much more easier than going with the manual way of filing of the returns or going to the compliance. Then it is a flexible threshold limits for the businesses related to VAT, TR, and registration. That is the flexible threshold limits here, where there are two limits, as we all know. One is the mandatory limit, which is 375,000 dirhams, and one is a voluntary limit, 187,500. Again, this was depicted that if the government was quite flexible enough for people to join in the TRN registration, and it was not a compulsion for everyone. So everybody could take the ease considering the size of the business and the start of the business. So definitely, this was one of the benefits and one of the much appreciated benchmark. Then it was regarding the schemes to facilitate and encourage trade and commerce in the UAE economy. So as I told very early that this indirect tax law was here to facilitate and to encourage other businesses in the UAE economy to grow and to boost. So there were other facilities like, the healthcare were zero rated, the education system was zero rated. For oil and gas, also it was a zero rate. And there were exemptions in the financial transactions. So that kind of a move was very much welcomed, and it was, to protect, to encourage, and to make everybody comfortable. Since nobody, never in the history, the tax was ever introduced in the UAE VAT law. So definitely, this was something that has to be made more comfortable, made more easier for the tax recipients to welcome VAT with open arms. Fourth is the expanding the horizons of the global opportunities within the UAE economy. So this states that being in power with the world, like since all over the world, all of the countries does have the VAT indirect tax, not I'm considering VAT, like India has GST, other countries have corporate tax, VAT, and saying of corporate tax, now even the UAE has come into power with the world, and so that's what it was asked to. I'm just really sorry for that. So it was required to expand the horizons of the global opportunities with the UAE economy. Encouraging tourism industry with tourist refund scheme. It was said that Dubai is very well known for tourism market. It was very well known for the welcoming the tourists during the October to March season, as we all know. But to encourage more of that, the government came up with a tourist refund scheme, which would encourage people to shop more, buy more, and to flourish the local industries which are here, and also to help the economy in a better way. Going forward is present circumstance of VAT law in UAE. I may just take a few seconds break because I think we are facing some technical error. Just a second, please. But apologies for that. Actually, we had a few technical issues. That is why I had to go on mute. So going forward, as I discussed, why the VAT law was actually implemented, what was the reasons for it, how exactly the conditions or circumstances were helping out the business economy. Also to say here that there were amendments by the VAT FTA from the FTA government. Okay, and it was a very significant one was in the year 2020. As we all know, for the zero rating export of the goods, there was this condition that even when the principal would be considered as outside the UAE, that was either or was a situation. If the supplier is staying here less than a month in the UAE, or if he doesn't have the establishment here, it would be considered he's an outside UAE. So this condition was or, okay, as per Article 31. But then in 2020, there was a slight change of only one word. It was substituted from or to and. So now both the conditions are mandatory. One, if the person is not in UAE, then earlier, if he was not in UAE and if he had a fixed establishment, that was okay. But now it's not the same. Now the principal has to be in the UAE. It has to have a fixed establishment also in the UAE to have this kind of to be a taxable one, or to be qualified for the export of service thing. So you see, FTA was earlier also bringing in certain kind of amendments, which were smaller, which was not much in a bigger magnitude or in a bigger volume. But here or there, somewhere there were the changes. Even to highlight the changes like in the public clarifications, FTA brought out public clarifications. That is for the people to understand, to make them realize that um, what exactly the VAT law wants to interpret. Like that is a main actually a challenge that everybody faced in 18 and 19. That was interpretation of the VAT law. Now, to make it more easier, that certain conditions or certain sentences, to make it more simpler, this kind of we say public clarifications were out, certain ways, if there were any court cases done unsought, then private clarifications were out, but that were only privately and exclusively for the particular industries. So, coming with which, this time the FTA has got sort of a lot of amendments, which will be effective from 1st Jan 2023, and the tax procedures that will be effective from tomorrow, that is on 1st March 2023. So, considering the present circumstances and the changes, we have only generalized the view, obviously, because considering it will be more convenient. And also regarding the industry base, yes, definitely there are. But as per my observations, this times the amendments which were brought, there were many few that were new clauses that were added, but many of it which were only to bring in more highlight, more in limelight of the taxpayers or tax recipients, just to make them more sure what exactly the law wants it. Indirectly, the law has already stated it, but yet there were some points which were simply identified as separate points, or highlighted more better in the new version of the federal law and the executive regulations of the same. So going forward with the present circumstances and the regulations, going with it, as we see on the screen, it's the first, it's tax Article 21 for the tax deregistration cases. Article 33, the agent, the place of residence of the principal. While Article 36, value of supply and deemed supply for related parties. Article 45, goods and services subject to zero rated. Article 48, reverse charges and its impact. Next slide, please. Article 6, Article 55, that is recovery of recoverable input tax and its impact. Article 62, that is mechanism for output tax adjustment and its impact. Article 74, that is carrying forward the excess of recoverable tax and tax recovery. Article 79, statute of limitation, which in fact is a very new clause and which article that has been added in the federal law. And the 10th is directive fees. Going forward with the slide. So going forward with the slide, we start with the Article 1, that is Article 21, the tax deregistration cases. So now here, the authorities, they have just mentioned that in their power, they could issue re-registration cases for the companies if it is prejudiced to the law, like if it is harmful or it is just not as per the law, or it is not or the organization, the business that is being conducted is not as per the law, then definitely the authorities have the right to issue them to deregister the company. Earlier, deregistration for the companies were done when the companies had the taxable supplies going below the tax voluntary limit, that is 187,500, or they had the XYZ reasons to close down the business. Like in Corona, we saw many of the businesses being affected, and that is why we saw many of them going for the deregistration of the same. So here in this Article 21, that this would go for tax re-registration, but going for tax deregistration doesn't relinquish or doesn't cancel the right of the FTA from claiming their liabilities if there are any pending towards the FTA. So definitely that would be the one thing, that we have to be payable. Even if they have asked us to stop the business, we have to pay the liabilities, tax liabilities pending towards the FTA. Going second is Article 33, that is the agents, that is place or supply of the place of residence of the taxpayers, was considered the location of the principal. So earlier what happens is, the place of residence of the taxpayer was considered for any transactions, okay? Any agency, even if there was any agents in between for conducting any transactions, or the principal residence, the person who's responsible from where it has been initiated, the transaction, that place of supply was earlier considered. But now there has been a big amendment coming in this, saying that the place of residence of the principal will not be such considered, but the place of residence of the agent will be henceforth considered for the same. So it would be very important right now that the place of residence of the agent is important. It would be considered, and the principal will have to take care of this if they want it to be taxable supply within the UAE. Okay, so the agents have to have a first establishment in the UAE in order to have a place of residence in UAE. So now the principal suppliers have to take care of the same. Article 36 is value of supply and deemed supply for related parties. So in addition to other articles, article number 37 was included in exception of this decree law for the purpose of value of deemed supply conditions. So here earlier, we know what it was, that if any related party is involved in the exempt supplies, the supplier should issue a tax invoice under the deemed supply concept with the market value of the goods or service, but not at the cost incurred. Now, I'll finally make it more simpler for you. Related party means what? Firstly, related parties means organizations having the same kind of management, a same board of directors, like a same management, that is called related parties, having more than 50% of the ownership rights. Now what happens is, earlier, now when two companies were there, they were treated as the same company, okay, indirect, informal way, not in the tax perspective way. So whenever they had to issue the tax invoices and all, so this was done in a cost-effective way. Like whatever, if I've bought something for 10 dirhams, I'm issuing the other invoice also for 10 dirhams. I will not add a markup, because why? Considering this is my own company, this is my business. But now this amendment says very particularly that if there is a related party, and if you are doing any deemed supply to them, deemed supply means any supply when you do it, irrespective of the price consideration, like a free of cost, like FOC, that you say, free goods. So if you do that, you will have to, hence you will have to bill them, for them on the market value, not on the cost basis. So it has to be like a 5% tax invoice issued to them, like you would do to any of your customer or persons. Going forward is Article 45, goods and services subject to zero rated. So in this, it mainly actually implies on the documentation part, like to more highlight we could say that like imports and all, exports and all, like we have seen in the market, there have been many of the FTA inquiries or FTA assessment based on the documentations, okay, that they have been not keeping or not recording proper documents. Now, what kind of documents are we looking in when there is in foreign imports? So considering here, the imports would be the bill of lading, the custom declaration, the invoice, or the commercial invoice. So these would be the important documents for the imports. For the exports, we all know that everybody right now in the trading businesses or in the shipping businesses are facing a bigger problem having the exit certificate, which we shall discuss in the coming slides. But just to give you a brief hint on the same, that in the exports, we require this exit certificate that has been issued when the goods are been inspected by the custom authority and when they leave the port, which act as a base for an evidence for the exports. If you don't have that, then that could be considered as 5% taxable goods. So here in this, it was only told that they must retain these kind of documents on which the input tax has to be paid or declared, because that is important for the goods and services subject to zero rating. So going forward with the slide, we have Article 48 that is considered for the reverse charges. So in this, actually, the amendment has come up for the hydrocarbons. That is in the hydrocarbons, that is like earlier also hydrocarbons were there. They were considered for the zero reverse charge or zero rated. Now, what exactly a reverse charge means, I shall define that. That when you have an import, okay, the supplier is outside the UAE. So definitely the government cannot go to that supplier and collect the VAT tax, which is due for the particular transaction. That is why the importers, when they import the goods, they actually pay the tax related to the transaction, and then they reverse it out in box number 10 while they're filing their VAT returns. So that's how this procedure goes about. So in this case, suppliers of hydrocarbons were amended for 48, like pure hydrocarbons. Now I will just explain in some few lines what a hydrocarbon means. A hydrocarbon is actually a kind of element which is used in lubricants and plastic factories, and I guess so. So I like very few knowledge about the same, but most probably in the oil and gas and the plastic manufacturing lubrications industries, yes, it's been used. So here they say if you use a pure hydrocarbon, which means an element of pure hydrogen and oxygen, then it is hydrocarbon. Yeah, hydrogen and oxygen are, I think, yes, this is right. So then this would be completely eligible for the reverse charge. But if this hydrocarbon is not pure, but having enzyme additives or anything, including any other elements, doesn't have some mixture of the same, then it will not be eligible for the reverse charge, but it shall go for a 5% or standard rated supply. So that's what an hydrocarbon is. So pure hydro, if you are dealing with a pure hydrocarbon, then yes, you can take a reverse charge. But if not, then you will have to either, apportion what, if you can, that if this much percentage of pure hydrocarbon, this much, if not, if it is possible, then I think so you can. But otherwise, it will be standard rated. Going forward is Article 55, that is recovery of the recoverable input tax. Now, as in the previous articles that we saw for Article 45 for the imports of goods, where they are stressing on the importance of having the documents for the imports, the same thing has been stressed for the recovery of the input tax. Now, we have seen since 2018 onwards that we do collect tax invoices from the suppliers, but those invoices are actually not as per the FTA at times. Okay, and there are some discrepancies, there are some shortcomings in those invoices, and at times, because we have changed the office place or XYZ reasons, we do not retain the invoice. Now what happens this is when the FTA comes for a surprise visit or a surprise assessment, or if you have any refund which is pending for a longer period of time, you will have to actually present certain invoices if the FTA asks. Now, in absence of which, If you don't have the invoice, definitely you cannot claim the tax. That says the law. So that is why it has now stressed the importance of why exactly you must retain the input tax invoices. And also, it's very important that we must be considerate of the 5 reasons of having a tax invoice, like the 5 pointers of the tax invoice. That is one, date of invoice, tax invoice number, the TRN, the address, the name of the supplier, the TRN address, and the name of the customer, the particulars of the invoice, the amount in the invoice, and the total, the 5% VAT rate in that. So this is actually what a basic tax invoice should look like, even when you're issuing it, even when you're receiving it from the suppliers. Also, usually in the law, earlier also it has been said that it's a normal 5 years. We have to have the books of records with us, but sometimes what happens is, for some reasons, we do not retain the invoices, or we're a little bit ignorant of the same. But stating, coming with this article, it has now very straightforwardly been put up that you must have to retain the invoices and in order to claim the input tax. So that's what was for the recovery of the recoverable input tax. Going forward is Article 61 of the output VAT adjustment. So here it has been said that if you find some discrepancies in the VAT adjustment, or if there is any, I think you shifted the slide. Okay, yeah. So sorry for that. So if you have some output adjustment, like you understood there is something returns to be provided, like returns is received from the customer, and there has to be any credit note to be issued for the same. So if in case, if there is anything that you have to be adjusted, you must issue a credit note. Earlier also, we knew that it has to be followed, but what happens is at times people were issuing a debit note for the same. So a proper practice of a tax credit note was not being followed. Like as per Article 60, if I'm not wrong, that there are the conditions which has been put forward for the tax credit note that has to be issued, the guidelines. But unfortunately, in the UAE market, we see still the practice of debit notes going around, considering it being an internal matter for them, that, okay, it's an internal understanding. He has adjusted, we have got the amount, and so on and so forth. But now FTA also understands the situation, and that is why they have been highlighting the points up, like this one is of Article 61, that where the taxable person applies an incorrect treatment, should issue a tax credit note to adjust the output tax. Also, along with this, there comes the second amendment that comes up, that if there is anything that you have seen a discrepancy and you have to issue a tax credit note, then kindly issue it within 14 days. Okay, so earlier, there were only a time bar for the tax invoice that they were saying within 14 days, yes, you have to issue, but now for the tax credit note itself. So the point of issuing the tax credit note would come after, once you have seen, you have observed the discrepancy, or you have returned received the goods, and you'll have to issue a tax credit note. So that will be the point from there, the 14 days would start. So now also, as I said earlier also, the amendments are basically to certain points, are to basically highlight and to bring into limelight certain conditions that were earlier ignored, or they were not being practiced so much wider in the market. But now it has been just brought up so that the people are more aware what exactly the FTA would require and how it has to follow the FTA regulation. Going forward is the Article 74, that is the carrying forward of the excess of recoverable tax and tax recovery. So as per the new provisions, the authority will have right to cut off if there is any excess of liability or administrative penalties against of the recoverable tax which shows in your portal. So don't be shocked or surprised if there is you have a nice refund position and you think that, okay, this I will use or I'll take a refund, but against which you have received any penalties, or any liabilities, then it should be directly set off or be directly adjusted against the same. Going forward, that's point 9. Uh, okay. Okay. So going forward, the statute of limitation, that is the new article that has come up. So actually, this was being said that for the tax law, the FTA has now within 5 years, it has a scope to open an audit. So to open an audit, they have 5 years from the relevant tax period, or within 4 years from the date of notification of the tax audit by the FTA. So now this has been very commonly observed. Why? Because the 5 years have been ended from 2018 onwards. So 2023 is basically the 5th year. Thus, the auditor has the right to open the books within this 5 years, depending upon the tax periods that you're facing with. So going forward, in case if you file your VD in the end of the 5th year, that is your, I could say 2023, let's take January 2023, till let's taking it a monthly based of VAT filing. So Jan 2018 till Jan 23 is the 5 years that is ending for that tax period. So in that case, in the Jan 23, up to Jan 23, FTA can have an audit assessment over this company. Or like very recently, I've seen in my example, all in my experience, that FTA now has given audit notification just before the 5 years ending for one of the clients. And for them now, it's a 4-year like an audit notification where they've said they have to preserve the books for next 4 years now. So now how does this happen is like, even if even if you received an audit notification within this 4 years, anytime the FTA can go for an audit assessment. So you can have an audit with them. Also, it also states that if the VD is filed at the end of the 5th year from the end of the tax period during which the FTA must complete the tax audit within 1 year from the date of submission of VD. Considering you're submitting the VD on Jan 2023, the end date 31st Jan 2023. Then from that day, the FT must complete within the audit within the 1 year, tax audit within 1 year from the submission date of VD. Also, may conduct within, if there is a point of a tax evasion, like considering if you have concealed, you have not reported the facts properly to FTA, you have been hiding or manipulating certain transactions. So this could lead to tax evasion as per the FTA, and thus it could ask them to give you a notice, and they can open the books of accounts for 15 years if they suspect so. And also there is a new clause that has been states that a VD, earlier a voluntary disclosure, did not have a timeline, but right now they have a timeline that after the 5 years that has been lapsed, like good example, Jan 2023 is lapsed and today is 28th February 2023. So once this period lapses for that particular tax period, like if it's a monthly tax period, for that particular tax period, you will not be able to file a VD going forward. Like on 1st of March, you cannot file a VD for 28th Feb 2018 because already the 5 years of which has been completed. So that's what statute of limitation has been saying about. I would just director's fees. So now earlier there was this general rule that any natural person or a legal person who's providing a taxable services will be considered for the VAT purposes. And even if the services were on the regular, ongoing, or an independent basis. So now this says that directors who are giving their professional services in the companies on the board of directors, then that is when they will have to be registered for the TRN and also be paying the tax for the same because of the professional services they are being received. But now a big amendment and a big change has been seen here, and which is a good news. 1st Jan 2023, any natural person performing the can't. Okay, fine. So As per the cabinet decision of the federal law decree number FAT law, effective from 1st Jan 2023, any natural person performing the duties of the board of directors or a member at a government, private, or an entity in exchange of the monetary reward will not be considered for a taxable service supply. So any directors now who's giving their independent services to any of these entities will not be considered for a direct taxable supply, which means will not be required to register for the VAT TRN. Similarly, now if there are two companies, okay, company A, company B, and company A is asking a natural person to represent themselves in company B as a director, then that will not be qualified for a not taxable supply of services. That would be considered taxable supply of services. So this amendment doesn't extend to any legal person, whether private or public, who may delegate a natural person to act as a director in their own name. That is why all the services would be considered taxable supply, but any natural person who's acting as a director in other companies providing their services would be considered as will not be considered as a taxable supply. So they will not be required to file or register themselves for the VAT TRN. So but also there is one catch in this. Now, considering we see that this kind of a contracts are usually yearly, usually 3 years, usually 5 years, dependent on the management. So we have to take care that the services effective from 1st Jan 2023, any services provided by them, because since you are being calculated from the date of completion of the service, right? So you'll be accounted or you will be paid for. So only from 1st Jan 2023, these services by the natural persons won't be considered as a taxable supply. But before 1st Jan 2023, that is up to 31st December 2022, these supply of services will be taxable. Okay, so kindly please make a note of that only from 1st Jan 2023, these services won't be owned, and services provided only by natural persons will not be considered as taxable. Other than that, all would be considered the same, the taxable, as it was in the previous law. So going forward, these were the actual important amendments that was in the federal law, number 18 of 2022. Now, going forward, we shall see exactly what were the amendments brought in the tax procedures, that is federal law number 28. So going forward with the slides. Okay, so again, I would like to say that we have very generalized these pointers so as to cover and to explain to everyone, not to completely industry specific. So if you find that some of the amendments may not have been addressed because there were some industry specific, and I think we have an audience in generalized point of view, thus only generalized base of pointers have been brought into the presentation. And going forward, that is Article 5, that is translated copies. So a new clause of 3 has been added to Article 5, indicating that a person who submits any translated copy of data, information, records, or any other document related to tax authority shall be responsible for the accuracy and correctness of such translated copies. And they should also bear all the costs, and the authority has a right to rely on these translated copies completely. Now, what does this state? Now, whenever we have to address the FTA or the authorities, usually it has been asked to provide in an Arabic version, which is more convenient, more easier for the government to review in. At times, they do request this. So when this happens, we have to translate the complete document of an English document to an Arabic version. So when this translation takes place, now this article asks the tax recipient or the payer that if this translation has been done, kindly take care that you are responsible for all the facts that you have provided in. We cannot give an excuse of a translation of a new language to a new language. We cannot provide an excuse that, oh, because of this translation, we missed out on a point. No. So a person has to be responsible when the facts of the documents are being translated to some other languages, Also, FTA will rely only on the translated document, and they will also not take any responsibility of going back and reviewing the earlier document that you've been provided. So, please be very careful while you draft such documents and when you provide the authorities in an Arabic version or any translated copy that they have been asked to. Article 9 is determination of payable tax. Now, Article 9 says that authority will apply the overpaid taxes, tax credits to unpaid tax liability. So this is more like in the previous slide on the federal law that we discussed, that the authority does now have the right to adjust your tax credits if there is anything which is reflecting on the portal. It shall adjust with that. So definitely, if the taxpayer is not giving a proper allocation, like when you in the new IMAR tax portal, when you have to adjust, so you have to provide an allocation against which you are paying, against which period you are paying. If there is something provided like that, the authority has the right to adjust your refund, the credits which is being reflected in the portal. Article 10 tells of voluntary disclosure. So we all know why a voluntary disclosure was earlier filed. What was it used for? So firstly, I would just give a small background introduction. Why exactly a voluntary disclosure was required? So voluntary disclosure was to be submitted when there is an expected liability, tax liability is more than 10,000 AD, and there is an error and omission for the same. And you would go and you would file a BD so as to avoid, or if you have any refundable position, then you would have filed the same. But going forward from tomorrow onwards, that is from 1st March 2023 onwards, irrespective, you have an omission, you have an error, even if there is no tax difference, even if the tax impact is zero, you will have to go and file for a voluntary disclosure. No doubt, there is still a kind of a hesitation between the taxpayers that what to do, to go for the voluntary disclosures or not. Definitely, it does add to your risk score. It definitely it will highlight you in the portal. But this move by the FTA or this article to be introduced is to just make the tax recipient more confident that if the error or the omission is genuine and they really want to go forward and correct it, they're most welcome, because every correction doesn't bring an audit assessment, which I have observed and heard from many of my clients that no, if a VD is filed, definitely there would be a knock from the FTA. But definitely that's not the case. But yes, it's an step to encourage the taxpayers to go forward and to revise the returns if required from their end. Going forward, the next slide is the right of authority to perform the tax audit. So regarding the period for notifying the taxpayer regarding the period for notifying the taxpayer by the authority to conduct the audit, the new time frame is 10 working days. So now, if you receive, God forbid, may not receive this, but if at all we receive a tax audit assessment from the FTA, earlier the time period was 5 working days, but right now it'll be 10 working days. So you're getting more 5 working days in order to arrange the data, and also FTA will also require the same to notify an individual, which states in the coming next article, that is tax assessment, that it has to notify the individual in question of tax within 10 business days after the issuance of the audit notification for the same. So obviously this is a good news, because earlier we also know in 5 working days was very difficult to compile, arrange, and to provide the data to the FTA. And being with that, and considering the difficulties that the taxpayers have been facing, the FTA has been lenient and has given more 5 working days for us to arrange and to reply back to the FTA with the communication. Going forward, Article 24, that is administrative penalty assessment. Now, It happens that, like I was telling very earlier in the beginning of the slide of why exactly, what kind of an amendment, public clarification came up, and the other amendments that we were talking on. There was this one such assessment that had come for the penalties, which says for cabinet decision number 40, that was regarding administrative penalties, which actually stated out exactly for which reasons, for which transactions, for what reasons you might be charged penalty, how much that would be. And this was basically to tell the taxpayers that how the ignorance could be more hurtful, because obviously the penalty is higher. That's a big dent in the pocket. So, but here now FTA has shown a much more leniency, where earlier the maximum cap for the penalties were 300%. It has been regulated and it has been reduced to direct 100%. So it is like a 100% discount. So maximum is now 200% of the administrative penalty assessment. And earlier, there was this minimum amount of 500 dirhams that was being charged. That is, when there is any VDs for the refundable positions we filed, there was a minimum of 500 dirhams that were being charged, rather than the fixed of 1,000 or 2,000 dirhams. So that has been removed since of the this 100% discount that we have got of 200, like it has been reduced to 200%. So going forward from tomorrow onwards, the maximum penalties that that could be levied is on a taxpayer would be up to 200%. So that was Article 24. Going forward is Article 25, tax crime and their penalties. So now this is basically to address the tax evasions, which the FTAs have been, reviewing, and I have been observing in the market. So this article was definitely designed for the tax evasion in case of the present situation of the procedure laws. And they say that the tax evasion penalties include a prison sentence and a fine not exceeding 3 times the evaded tax. Again, the limit of the penalties here has been reduced. Earlier, it was a 5 time, but right now it's 3 times. And also, in case if you think we are too smart to deliberately hide or to manipulate or to conceal any facts, as I told you earlier, these things can result to a tax evasion, because a tax evasion is a criminal act, and it is act which could possibly go for a higher monetary penalty clause. And here the cap has been set as around 1 million dirhams. That would be the monetary part. Also, it states that that the prison sentence which has been mentioned here is not necessary to be followed, or it is not necessarily to be implemented, but it is just to make sure that if your crime is that big, or it has been that impact, there could be a possibility of the same. While for the monetary limit, they have stated the limit as 1 million dirhams. So these are being projected basically to make the taxpayers realize that it is not right to play with the law. It's not right to manipulate things. And it is very much required and very much expected from the taxpayers to follow the regulations. Okay. Going forward is Article 40, that is collection of payable and tax administrative penalties. So now here again, the government has been more to the side of the taxpayers, and they say that the Director General Authority may ask the judge at the competent court to issue an order for the seizure of assets of the person for an equivalent of the payable tax when it has been known that payable tax due to the authority are susceptible to potential loss. Okay, so this article states that if you have any penalties being paid, it is required to be paid, and it has not been paid by us to the FTA, which is their right, then definitely there will be a possibility that they could issue an order and they could have a seizure of assets of the persons. And now, earlier also we knew that in the in the Civil Act, on the Criminal Act, that the law does have this kind of authority in order to possess your assets. That is, first would be starting with the lower ones, that is your cars, then moving on to the bigger ones, such as a building or any fixed asset that the company possesses, just in case if there you have a loss, you're not being able to pay to the FTA liabilities. So this is just again a highlight in the course of the law that before any third party settlement, it's very important, and it's all known that the very first adjustment of the liability would be towards the government, and that is what has been stated. And it is just again to highlight that yes, this is the cause that the taxpayer doesn't then question later why exactly this process has been conducted. So again, this was not something new, but again highlighted for the taxpayer's benefit, so as to he doesn't come and questions the same. Article 28 is tax assessment review request. This is a new stage to dispute resolution process. It allows an application to submit to the authority to review its tax assessment related to its administrative penalties within 40 business days from the date of receiving the tax penalty assessment, if there is no consideration request already filed. Now, let me tell you what exactly a reconsideration request is. It does happen that we are not at times happy. We're not at times, we're never happy with the FTA's conduct of the the assessment, and they giving us the penalty tax assessment. So what we do is we do file a reconsideration request, a penalty waiver form, to to just reduce the burden of this monetary liability that has been imposed by the government. So now the authority says that, okay, if you really feel that this is not something right, you really have to go forward and to find a resolution for this. You could file a request again to the authority, an application to this within 40 business days from the issue of the notice or the order for regarding the payment of the penalties for the same. So this is a little lenient, and this could also, I think, help the taxpayers going forward in regarding to the settlement of their disputes or the penalties with the authorities. Going forward. Okay, so we have come to the last point of the tax that is in the tax procedures, that is tax refund procedures. So now here actually the authority has mentions that the authority shall offset the refund amounts with any other tax payable or the undisputed penalties before refunding any amount related to specific tax. Also, now it has added additional clause that why they could decline the refund. So from the federal law onwards or from the other articles that we saw just now before, that how the authority has the right to set off their the tax penalties or liabilities against the credits which has been reviewed in the portal. But now they also have mentioned why exactly if a refund is not being, it will not be provided to you, if there are any other disputed amounts related to taxpayer, if you have any amount that is again to be payable, and FTA thinks no, first you have to clear that, first resolve that, and then we would process your refund. That's exactly their right. Secondly, if a person has come under a tax audit, okay, you've got an audit notification, but considering we are in the 5th year, and as we saw that the FTA does have the right to issue an audit conduct an audit within 5 years and issue an audit notification also. So in that case, if you have a refundable position, then it could obstruct or it could delay the process unless and until they may have, observed all the points for the audit and after which they could take a decision regarding the refund procedures. So this was again the two main highlights, that why exactly your refunds could be delayed. Again, this is to make the taxpayer recipients understand that what could be the reasons the FTA might be taking the step to delay your refund, so as to avoid any collision between a fight between you and the FTA. So yes, going forward with this, is the challenges faced by business VAT law in UAE. This would be taken, this slide henceforward would be taken by our tax partner, Mr. Ahmed Sharafuddin. Before I exit and I take an back seat with this presentation, I would just give a brief introduction of Mr. Ahmed Sharafuddin. Mr. Ahmed Sharafuddin earlier was a tax auditor with the FTA. He has have a master's in the accounts, and he's been efficiently proficient with his I details for the tax audits. He is very much like deemed for the known for his solution providing assistance to his clients, and that is what his purpose was with this ITC, that to provide and to help many more tax recipients as he could not do from within the FTA, and while opening the FTA, that was his promise, and we have been keeping up with it. So that was a very brief and a small introduction of Mr. Ahmed Sharafuddin. So I shall hand over and he shall take forward with this presentation. Thank you so much for your time.
Hello, everyone. Thank you, Nikita, for the great introduction. Thank you also for what you have explained earlier. It was really so informative. So, hence, Ms. Nikita was speaking about the changes, and it's been 5 years and so on, and that we should be going for more compliance. If I would be able to give a brief about the changes that has been introduced in the law and the executive regulations, I will brief it in 2 words. That it is a big relief for the companies, and it is also in the way to have more compliance with the law and the regulations. Okay. So going forward with the challenges that has been facing the companies with the VAT over here in the UAE. To be honest, the problems didn't start yesterday, but like the problems has started from the beginning of the law. One of the major problems is the wrong interpretation for the law. We all came from different backgrounds. So everyone, when he read the law or she read the law, he had his own interpretation for the law. On the other hand, the FTA has their own interpretation for the law. So sometimes it like there was a big gap between the interpretation for the law between the taxpayers committee and the FTA. And in a lot of matters, I have seen that wrong interpretation for the law actually causing lots of penalties for the companies, because so far for the past 5 years, I didn't see a company who got a tax assessment or got a penalty was because of them trying to hide something or omit something. Like 99% of the cases that I have seen or worked on, inside or outside, it was only because of the wrong interpretation for the law. So it is very important to get the right interpretation, try to understand what exactly the FTA requires, so you would be able to give them what they want exactly. Going forward with the clarity of the correct disclosures of the revenue in the VAT returns. That's a very common that's a very common mistakes. There is a lot of common mistakes when it comes to the output, especially when it comes to the export of service and how the law has changed it in that, just by adding one by changing one word from or to be from and to be or. That was the only change that happened when it comes to the export of service. But it's not only about the export of service. There is also unclarity when it comes to the tax invoices, the output tax invoices, as an example for the contracting companies, for the advance payments and the retentions and so on. There is also one common problem when it comes to composite supply. If you are selling composite supply or one and get one free, there is also a problem when it comes to that. And going forward with the appropriate input tax claim by the tax recipient, there is a whole confusion when it comes to the input tax as well, especially what we can claim and what we cannot claim. I will just give one example, and let's make it the medical insurance. The medical insurance, it's well known that for Abu Dhabi, it is mentioned in the labor law that you should get an insurance for the employee, one wife and three kids. So it is mandatory for the company to make that kind of insurance, and the FTA is approving uh, their demands for claiming the input tax who was paid on that specific matter. On the other hand, all the other Emirates, you can only claim the input tax for the insurance, the medical insurance, only for your employees. That's one example. Going forward with another example, we can speak about like the cars, and for the cars, if you are having cars under the company name and you are using it for the sake of the business, then you have the right to claim it, to claim the input tax on such kind of expenses. But again, you have to maintain the proper reports when it comes to that. Maintain the proper reports, like a policy. If there is a policy that these cars cannot be used for the personal use, if there is an entry and exit log for the cars, that will be and add value to your demands when it comes to claiming back the input tax. The refund claim process. For the refund claim process, there were a formula, let's say an Excel sheet that has been provided from the FTA from day one for the refund cases. And after that, it got changed multiple times. It got changed for the good of the process of the audit itself. It got changed also for more clarity for the tax, for the taxpayer as well. Usually the refund claim, sometimes it takes longer time than it is expected. And the main reason for that is that there is no clarity when it comes to there is no clarity from the taxpayer side when it comes to providing the necessary documentation to the FTA. The acceptance and the issuance of the tax invoices as per FTA regulatory framework. When we are speaking about the invoices, here we are speaking about the invoices that we are issuing and the invoices that we are receiving. Basically, what we mean here is when we are speaking about article number 25 and 26 of the Federal Decree Law number 8, speaking about single supply and continuous supply and how we should issue our tax invoices. Not only that, but for the input tax, I still get some questions from like some of taxpayers. Can we claim back the input tax when we only have a commercial invoice or we have a pro forma invoice? So even so far till now, the people, some of the people does not know what are the important requirements to be issued to be mentioned in the tax invoice. And the first thing is to be written as it is a tax invoice. The exit certificates. The exit certificates, it is a more common and popular problem that people are facing right now, as it's written as it's written in the law when it comes to the export of service. The export of service. Uh, the export of not the export of service, the export of goods. There are some documents that should be maintained and kept in the like in hand. And when the law have spoken about that, they spoken about it, and they asked for two specific documentation, which is commercial evidence and official evidence. When the law spoke about official evidence, they only mentioned as per the customs regulations. If we will go to the customs regulations, we will come to see that the only official evidence is the exit certificates. Lots of taxpayers were not actually maintaining and keeping the exit certificates. Uh, were not keeping the exit certificates at all. So the FTA is insisting and they are asking for the exit certificates all the time. The penalties. We have seen lately that there is a lot of people who are facing some penalties. They are getting an executive order from the HTA for seizing their assets, seizing the bank account, and stopping also the license and so on. And even if you are having cars, also that will be under seize. So it is important for you as a company to try to avoid the penalties as much as you can. Otherwise, it might actually affect the business in a very bad way. The law has came with a big relief when it comes to actually asking the FTA before the reconsideration to look into the audit that have been done and the tax assessment that has been done, just to try to see if there's something has been done wrongly, and if they can try to take that burden from the taxpayer that maybe it was wrong, like he was wrongly penalized. So going forward to the next slide. As we were speaking about the exit certificates, the exit certificates is essential. It is essential for the FTA it is essential for the FTA to prove that those goods has actually left the country. And unfortunately, there was not a lot of people who has kept it and maintain it. So it is an obligation now for them even to try to get it backwards, or to get any official evidence that those goods has been exported outside. But as per the customs law, there is no official evidence but the exit certificates only. Going forward, the upcoming challenges in the for VAT law in the UAE. I will let Ms. Nikita to take over from here, and I will stay for the questions. I would love to continue, but as it is so obvious that my voice is not okay, but for me, it's an obligation to give such webinars. And being sick, it is not an excuse for me to excuse myself. So I have tried my best, but this is the maximum I can do. So Miss Nikita will take it from here, and I will be there for the questions as well.
Thank you, Mr. Ahmed, for highlighting the challenges faced, the previous challenges and the current challenges which were faced by the taxpayers in the UAE market. As we have all seen that exactly how important retaining an exit certificate document is, because trust me, without this, whatever you may have considered as zero rated supplies as your exports will be directly having a bigger tax exposure impact, having converting all those supplies of 5%. So just a request and just a help and advice that please, if possible, kindly collect that and before an audit assessment knocks your door. Coming forward, now we have now been through the complete presentations where we have been seeing the implementations, the need of the VAT law, what kind of an amendments, what kind of a change were brought in, and what were the challenges which were being faced by the taxpayers in the UAE market. Now, we foresee the upcoming few challenges that could be in the VAT, that could be faced by the taxpayers in coming forward in the few years. So we would like to state a few of them. That is, one is the VAT that is likely in case of an increased rate of VAT. It's been observed that in the many of the other GCC countries, like in KSA and Bahrain, the earlier introduction VAT rate was 5%, but it has been now increased to 10 and 15%. There could be the case here that we could foresee that since the VAT law has already been here for 5 years, there could be a chance. We are not saying that there is a possibility of this happening, but we are just foreseeing this as an upcoming challenge, like what the taxpayers must be ready and must be aware of the same. So considering um, the effect or the implementation that has happened in the other GCC countries, it is very possible that this could have in the near future, the rate of VAT percentage could go higher, and it could be because see, in when the VAT was introduced, it was to make others very comfortable. It was to make the tax recipients very much used to the fact of being accustomed to an indirect tax regime, which was not in the UAE market earlier. So definitely this would be seen as the one of the upcoming challenges in the VAT law of UAE. Second is the currency and that is digital currency. So we have heard in past 3 to 4 years this term called as the cryptocurrency, and we also know that everybody in this what do you say era, or in this few years, not era, in the few years, that people have become very used to with this idea of the having an exchange in the digital currencies, which makes it more easier and reliant in the further course as digitization is taking over in the UAE market or over the world, I must say. Then definitely the use of digital currencies may go up. So definitely, one of the things is that the law doesn't have yet any kind of an implications regarding digital currency. Like if it is for sale and exchange, okay, then there's just a payment method. But what if the currencies are being bought for as an asset by for the company? Then with the sale of asset, there could be a possibility that that should have a tax implications on the same, but for which the law yet is silent on it. And we see that coming as an upcoming challenge. And I think there would come that point that the VAT law will also have some point or some amendments in this also. for the digital currencies as well. Third is for the freelancers. Now we know that in the market, we have many individuals who are independently and performing their duties, performing their services, and giving a great services outside, which definitely is a cost reduction for the company and always a go-to thing. So definitely, this is being also not tapped in the VAT law. Why? Because freelancing is something that for the VAT registration, you require to at least have a mandatory limit of 375,000 dirhams. But if you see in the way, if you're a freelancer, how would exactly the law know that, oh, okay, this person has gone about 375? Because there is a possibility that these people will be dealing in cash. So definitely, yet there has not been a very what do you say, stated conditions or technicalities exactly how a freelancers and the treatment of the same as can be reviewed in, because these people can give the services within from their home to everywhere in the world, like because considering digitization is the time now, so definitely the application or the service providers will be perceived, the service recipient will be all over the world. So definitely this is one of the challenges that we foresee that would come up in the UAE law. So fourth is the e-commerce. So now digitization being the trend and being the next age. We know that many people have the e-commerce practice that they sell the goods like globally anywhere from any part of the world. So definitely, then how exactly we must be able to tap from where exactly the goods have flowed and or there has been goods have received and where is the supply of services being performed. So definitely there is a bit complications and in terms of this e-commerce thing, because definitely at certain point the transactions which are not concluded or there is no stop points being declared or not being properly mentioned, then definitely this could also be a challenge and exactly how a tax implication would be suggested over the e-commerce part. So, with this, I say that these were the few upcoming challenges that we have foreseen with the VAT for the coming after the 5 years we see with the new trend, new ages, new challenges, and new upcomings we see in the market. Now, going forward, this we have actually covered what exactly the VAT is, the very start till the very end, and how exactly in the future also we foresee. Definitely, it's been a very concise and in a very discrete way that we could, be providing you the information. Just to add to more it, like how can we be a help to you in exactly in cracking the FTA law, the interpretation, help regarding your other services. So I would just likely to briefly explain you how exactly the role of ITC has been and how it has been helping our clients, and we have been successfully been able to make our mark in the market and have been expanding our wings in the UAE market as well. So, firstly, by exactly ITC, as I state that Mr. Ahmed Sharafuddin, being one of our partners, he was one of the key persons who was responsible for founding this organization. He believed in providing solutions, those who seek solutions for their problems, and we have been providing that since 2019. And till now, successfully, we have been able to cater to all those problems, to all those queries that the taxpayers have been facing in the UAE market, and also Mr. Ahmed being next like having a past with the FTA, he does know the do's and don'ts. I may not say that he exactly knows the brains of the FTA, but definitely from his end, how much ever he could help the taxpayers to get relief from their considering the penalties or the tax assessments or anything with the FTA communication, he has been a go-to person for the same. Our achievement states that we have tax experts, we have three FTA approved tax agents. So we are a tax agent certified organization with as registered with the FTA. We have 2,000 plus client base, and they have a happy customers and 1,050 plus pre audits. And we have, as I said in my very growth chart, the very start, that in 2022, it was a landmark year. Why? Because our experts have been able to successfully reduce more than 3 billion tax penalties in one of the biggest tax penalty cases in the UAE. Yes. So that was one of the most sought to and the landmark achievement in our ITC's growth. Now, why exactly you must choose ITC? What is the benefit of the same? That is that ITC will help you to avoid the outflow of the money, definitely. If there is something called for the penalties, for the tax assessments, if there is something that we could help with, definitely an outflow of money is saved. So that is first benefit. Second is strengthen the books of accounts. Like we even review the books of accounts when we are doing a pre-audit, while we're conducting a financial audit. We definitely review to the books of accounts so as to make sure that your books of accounts don't vary from the returns that has been filed. Considering corporate tax right now coming in from the next year 2024, where you will be starting filing the returns and all, definitely strengthening the books of accounts is something that must be looked after, and it has to be organized. Documentation as per the followed FTA framework, as we very well spoke, Mr. Ahmed also emphasized on the documentation, the necessary for the same, that is for the exports, for the imports, for the input tax. It is we are very much particular in that aspect, that every client and the taxpayers do keep such kind of a documentation with them. Reviews of risk parameters for the company. So definitely there are certain risk parameters, like when I just mentioned that when you file a VD or when you don't file the returns on time, you don't what do you say, you have saved certain documents in the draft section. I have just forgotten to file the refund. Okay, these are certain kind of risk parameters for the company. Not every risk parameters is harmful for you, but definitely when you don't file the returns on time or you've not paid the tax liabilities on time, definitely this is one of the biggest risk parameters. That is something you should not give away, because it will give a red flags to the FTS with this. Now, corporate tax benefit is actually associated with the first point, saying that in the corporate tax, as we know that in the penalties that we pay to the government, that would be a disallowed expense, which means you cannot be able to reduce your net profit against the same, and definitely it won't have you any added advantage of paying these penalties. So you will definitely pay away a lot more corporate like a net profit tax against the same. Thus, if we are given a chance to review, definitely we will make sure we can, as much as possible, we reduce the outflow of your money, we reduce the penalties, and we provide this benefit. Now, going forward, how exactly we can support you, our team? First of all, we have a very experienced and a technically sound team who takes care and is aware of the every tax practice regarding the accounting, regarding the indirect and the direct tax, and who can provide you a complete support in the following manner. Like they will be helping you in maintaining all the financial records or tax transactions, any FTA communications related tax matters, representing you in front of FTA in case of any queries, felicitating, assisting the FTA on your behalf, for of if audits or inspections are conducted. Now, firstly, in this there would be the case that well, if we are involved in with you in your tax returns, tax assessments or review, definitely this will be all will be helping you with. Then is arranging or preparing all the documents for the audits, VAT, voluntary disclosure submissions, arranging the VAT deregistration process on your behalf. Also, there are other services which we will talk which we'll talk in the next slide. Like we have pre-audit, annual, and other services. Since this webinar is only very much related to the VAT, that is why these services are being quoted around. Otherwise, if you want any other services apart from these, definitely feel to contact us. So just giving you a very brief regarding what exactly these services are. Firstly, going with the pre-audit. So pre-audit is nothing but a VAT health check that everybody in the market is aware of. And we introduced one more version of a health check, that is a preliminary health check. Here we have seen that in the market that many of the clients or the customers are not very eager to go for a very extensive or comprehensive coverage. Well, they might be a little reluctant because they already have a different consultants with them. So that is what our main purpose here is, to just possibility to have a risk review. I think in the next slide, we have the preliminary health check detailed info. So as you can see here, that what we do here is we review your VAT reconciliations, we review your trial balance reconciliations, since it's very important, as we also said in our benefits, that we strengthen the books of accounts. So obviously reviewing your trial balances, which will help us to give a sneak peek of your accounting, how exactly the books of accounts has been maintained. So this review helps us to know exactly how the books of accounts and the VAT return do tally or not. In review of the samples, here is the part that in the comprehensive health check, that the one full pre-audit we do, we take definitely a 70% sample checking minimum. But here, considering it's a preliminary and it's just an outline, so we will review a 1 quarter or a 2 quarter per year basis, depending upon the risk areas that we have it. So definitely this kind of a health check is only to identify if the company is having any discrepancies, anything that has been ignored in the previous, because 18-19, we know it was a very mess year, because people were really trying to align them with the FTA framework and to understand the implications of the same. Also, then reviewing these samples, we will draw observations. We will provide you what kind of an areas, the gray areas the company must take care of. Definitely the tax exposure in this would not be included, because if you require a complete tax exposure, exactly how much the company would liable, then I think would be preferably to go with the comprehensive pre-audit health check, and according to which a report will be issued to the client for the same. The benefits for this is very quick. That's first, it's a quicker process. It won't take a longer time as it requires to review every tax period in other case. It's a reduced price considering from the comprehensive health check to preliminary. As I said earlier, identifies discrepancies or challenges. It provides an advisory services, like if you have any queries, any concerns related to VAT, definitely you don't need to feel hesitate. You can completely come to us and ask regarding your any queries. We'll be very happy to help you with, and also to have a financial overview through TB reconciliation. Going back to the previous slide, we have annual services, contract services with a tax agent service and without tax agent service. So with tax agent is where you are linked as a tax agent with us, and without, which means a normal, where you will be responsible for filing your VAT returns and reviewing of the data then also. And also this kind of a service does also includes the advisory services. So definitely we don't believe in letting out our clients from any advisory if they feel want to. We would like to have them comfortable with us, with our services. Thus, the advisory services are included in every service that you take from us. The other services are the refund claim, filing of the voluntary disclosures, litigation process, reconsideration, penalty waiver processes. This could be discussed as per the depending on the client basis, but these are the other services in related to the VAT area that we provide to our customers. So with this, we have concluded our VAT webinar for the type years. I hope we have been able to present you and to provide you the kind of information that you were seeking in. Apologies in for all the technical errors, or if you were not, I was not been audible, or there has been any problem or so forth. And now's the time for Q&A. So Mr. Ahmed and me shall be together taking the question and answer section. So going forward. Going forward is Ms. Shakil Tuladil, okay, Shakil, you have been asking what are the precautions to take after coming of corporate tax. I don't think so. The precaution, something after corporate tax should actually affect VAT, because these are two different things. VAT is based for the indirect tax and the corporate is based on the direct tax. So definitely there is no kind of an overlapping in between those taxes. So no such precautions apart from the challenges that we told, and we have asked them the precautions for the same. Same question from you. When we purchasing a product and invoice show the buyer and seller TR on the bill, yes. As per Article 59 of the Executive Regulations, it definitely states that the pointers that requires to have the when you issue an invoice or you receive an invoice from the supplier. Yes, if it is a simplified invoice, it's less than 10,000, definitely there is a relaxation on that part. But usually we do recommend our clients to only go for all the points on the invoices, as I've also stated in the presentation as well, and also as per the VAT law. What is hi, Mr. Kambur. Good morning. I would like to know if customers submit the invoice of the last year date 1st Feb 22 and Feb 23 via email. Is there any possibility of claiming VAT on the invoice, or we have to expense out VAT on those services? Okay, Mr. Ahmed, I think your expertise would be much better if you could highlight this.
Can you please say it again, or which question, so I can just go to it?
It was by Mr. Kambar Razak.
I cannot find the question.
Okay, the question states that if the customer submit the invoice of last year dated 1st Feb 2022 in Feb 2023 via email, is there any possibility of claiming the VAT on the invoice, or we have to expense out the VAT on those services?
No, now, if you didn't include that input tax, okay, in your previous VAT return, and you just received the invoice right now, then you can claim the input tax in the current tax return, because the tax point for the input tax is based on the received date of the invoice itself.
Okay, so I hope, Mr. Kambil, we have answered your query. Okay, just a second. I'm really sorry, because I see that there were many things that they could not hear me very well. Apologies for that. As I said, it was something not foreseen before. Okay. What is the bad guidance? Mr. Mohammed Chand is asking me. I think you could elaborate this, Mr. Mohammed. I don't know exactly what kind of a bad guidance are you looking for. And in case if it's something, I will be more than happy to be able to have a personal one-on-one person meeting. Uh, okay, accounts. I'm really sorry for this. Okay, okay, okay. Oh my God, my voice was really bad. Okay, going forward. Um, Tanveer, should I charge at 5% when exporting the goods to Saudi? Can I claim VAT when I import goods from Saudi with the VAT invoice shows 5% VAT? Um, Tanveer, I think when you're exporting it something out, definitely it is zero rated. So there is no question of having it 5%. Again, if it's on an international basis, if you're having any domestic leg, if you're just participating only in the domestic part of the transportation of goods, if I am thinking it right, then I think we will be able to comment on this. But other than that, if it is going outside UAE, definitely it's a zero rated. And can you claim input VAT when I import goods? Yes, you can claim import if it's an RCM basis. So definitely you should have your documents in place. And you can first show in box number 6, which gets pre-populated, and then you can take in box number 10 in the VAT return. So I hope, Tanveer, this solves your question. Okay, under Article 36, what is the impact of VAT group companies? Can you give example for concerned goods of services under Article 45? Okay. Mr. Ahmed,
What are the impact of tax grouping in the
yeah,
VAT?
Article 36, yeah.
I'm sorry, I don't have the law in front of me right now.
Hmm.
So if he can send what exactly he wants from the law, exactly.
Okay, agreed. And can you give example for concerned good or services under Article 45?
Again, law is not in front of me. I would like if he would actually make his question more specific instead of explaining a whole article in the law.
Okay, so Mr. Mastan Arif, I would actually recommend of you to provide us an email. The email address is been provided here on the screen as well. So if you could just email your question out because it's little in generalized view you have been asking us. So it would be very easy for us to answer your question. Okay, Sayyid Imran revise who will not be considered a taxable person? Any person who doesn't, Mr. Hamud, okay, Mr. Hamud Rahman, who will not be considered taxable person, any person whose taxable supplies is less than 187,500, then for that period, for that one period, they will be not considered taxable person. But if there is something else that you would you're aiming, which I've not been able to understand it, but yes, that would be not a taxable person then. This means that if director has shares, he's under VAT. What does exactly this means? Like director has shares, he's under VAT, Mr. Vivian Fairs. If directive fees is something that I would just take your other question, Mr. Vivian, that this is only basically on the remuneration that a director is receiving when he's attending the board of directors meeting. And that has been considered as a not taxable. But I'm not aware if there is something director under shares that is something little different, and it has to be dealt differently. Okay. Is there any lectures in Arabic? Del, I'm sorry. There should be, but we are not aware of. If so, kindly please answer. You can search that. Uh, okay. In line with audit assessment, is the timeline increased to 10 working days, even in case of refund inquiries? Refund inquiries is something different. It is depending upon the FTA, but yes, for audit assessment, it has increased to 10 working days. For refund queries, I guess it could be, but again, it depends upon the auditor to auditor. Usually, they give a good period of time, even in the case of refund inquiries, to arrange the data. Can we get this material? Yes, you can talk to the commercial team for that. Hi, good morning. Have a question. Recoverable tax on the paid VAT on pre-registration period. How a person can claim an input tax before his tax registration for VAT for business after 1 year? Can
Like,
input
you can claim back the input tax that you have paid prior to the tax registration for 5 years under but with one condition, that those input tax or those kind of goods of services has been used to make a taxable supply after the registration of the VAT. So you have 5 years if
so
whatever you
Miss
are paying. Yeah.
So, Ms. Sunita, I hope you've understood, you've got the answer. And also in regarding to procedure is nothing, but when you get eligible for filing the VAT returns, you shall be claiming it under box 9 of the VAT returns, and you can claim the input tax for the same. Am I right, Mr. Ahmed?
Yes.
Okay. Have the implementing, sorry.
Absolutely correct.
Okay. If have the implementing states been notified? If not, when, how would they implement? Okay, Miss Tanveer, I guess you would require to more brief on this because exactly I'm not able to understand on what context is implementing states you've been asking for. Request you to email your queries, please. Kindly, okay. If there is a time frame or period when can we claim input tax? Usually, an input tax is claimed when you have received the invoice. So also and you must have an intention to pay the invoice. That is one of the conditions. So if the two conditions are, I think, fulfilled, you can claim your input tax. Next, please, what is the proper treatment for advance and retention for construction contracts, Mr. Mohammed?
That's a very wide question. So the just to answer it in brief, and if you would like to have more clarity on whatever I'm going to say now, in brief, you can also contact us for the advance payment. If you like for the advance payment, we have two conditions. We have two examples. If you have received any advance payment prior to 2018 and it's pertaining to projects that's still ongoing after 2018, then you can make the apportionment for it, and whatever you are going to finish after the start of 2018, then that is taxable. Whenever you are getting the second after 2018, if you are getting any advance payment, that is taxable. For the retention, if you will invoice the retention, it is taxable, which it means normally when you are invoicing any company, you are making like work done minus advance minus retention. You cannot minus the retention in the invoice. Minusing it means invoicing it. So you cannot minus it. Either you don't mention it, and I know it's a requirement from the consultant, but again, you can, if you are going to mention it in the invoice, then you have to collect the VAT on it. As
Okay.
per article number 26.
So thank you, Mr. Ahmed, for that reply. That is for Mr. Mohammed Gharani. I hope you have received answer to your query. I think there have been too many questions in regarding to the VAT, and I really understand why exactly it is. So we shall be taking this one last question, and I would request all the participants that for your query, try to contact by a mail so that we could answer and we could get in touch with you. Considering the very last question, that is for insurance. What about claiming input VAT on insurance for company based in Sharjah, since employee insurance is not mandatory in Sharjah by law?
It is not mandatory in Sharjah by law, but it is mandatory by the FTA, and they have taken it as practice in Sharjah and Dubai and in all other Emirates except Abu Dhabi. that you can claim back the input tax for the employee.
Okay.
So it's not mentioned in the law, but it is your right as per the practice from the FTA.
Okay, so Ms. Oksana, I hope you have received, if you are there right now, you have been answered to your query. The very last thing, Mr. John Chaco is asking that what you mean by exit certificates in case of export. Is it the same as bill of exit issued by customs when goods are crossing the border? So as per
the exit certificate, it is like it is a certificate that to be issued by the customs, and it should be signed, stamped with 3 stamps. Like the first one is the first inspection and the DB World stamp, and the third one is the final inspection. It's not bill of lading, it's a unique paper that it is issued by the customs itself that actually proves that your goods has been exported outside the country.
Okay. So thank you, Mr. Ahmed, for that. And I hope Mr. Chaco has received the answer to their query for the same. And thank you all the participants for joining in. Apologies, and unfortunately, since we are running out of the time and there are too many questions and it will not be possible that for us to answer them each and every one. So we would request you all to just email them on the email address that has been shown on the screen right now. So as to be able to reach out to you and answer your queries in complete details. Feel free to reach out to us. And we have been very supporting and a very patient participants. So thank you so much for participating in this webinar. And we really appreciate your time and presence here. Thank you so much. This is until we meet next time with some other topic or to just bring to your highlight. Thank you. Thank you, Mr. Ahmed, for your presence and your time as well.
Thank you, Nikita. Thank you, everyone. Have a nice day.